It's Wednesday, July 8th. Let's break down what's happening in Korea's financial sector.
Yeah, let's get into it.
So our mission for this deep dive is to really give you all a measured, regulatory precise analysis of Korea's shifting compliance burdens.
Yeah, and we're also going to look at the institutional profitability shifts happening alongside that.
Exactly. Because, I mean, the landscape right now is changing so fast. For instance, the Financial Services Commission, the FSC, just formalized this new mandate for major firms to appoint a CIRO.
Yeah, a financial inclusion executive, which, functionally acts like a chief compliance officer strictly for inclusion metric.
Regulators are setting specific performance targets behind closed doors.
Mm-hmm.
Isn't that exceeding their direct statutory authority?
Well, yeah, industry lawyers are definitely pushing back on that exact point. They see it as a massive overreach.
I can imagine.
Because it creates this completely unpredictable compliance burden. I mean, if the CIRO's career review depends on hitting an unlegislated quota to underserved groups, it heavily distorts credit allocation.
Right, banks just end up forced to lend based on a mandatory metric, not a precise evaluation of actual risk.
Exactly. It just bypasses the standard statutory processes entirely.
Wow, so that's a massive squeeze on the commercial side. But if we pivot to mutual finance, the compliance pressure there is mirroring this huge liquidity stress.
Oh, absolutely. The cooperative sector is practically running out of cash right now.
Yeah, the numbers are wild. Korea's credit unions, the Shinhap network, they just lost 15.2 trillion won in deposits.
Which is roughly 10.9 billion US dollars.
All right, and that was in just 4 months. People are just chasing higher yield commercial accounts. They're deploying cash incentives on membership accounts to stop the bleeding.
Yeah.
Isn't that like putting a Band-Aid on a bursting dam?
It really is. And the Financial Supervisory Service, the FSS, they're already stepping in to inspect whether these reactive schemes actually comply with cooperative finance law.
Oh, so the regulators are stepping in there too.
Yeah, we're basically waiting on their Q3 2026 inspection results to see if corrective orders follow. And if they do, that's a second heavy compliance layer stacked right on top of a sector that can barely maintain its deposit base.
Man, it really is a brutal squeeze all around. But while credit unions are scrambling for liquidity, you have commercial players leveraging capital efficiency to really pull ahead.
Right, like Hyundai Card.
Exactly. I mean, they've poured 1 trillion won, so about $714 million, into data infrastructure over the last decade.
And we are finally seeing the operational return on that massive investment. They use a proprietary AI model to test thousands of marketing permutations entirely autonomously.
Which is how they cut their marketing design time from 3 business days down to just 40 minutes.
Right, 40 minutes. But, it's not just the speed.
What else is it?
It's the mechanism of their scale. They aggressively built a private label credit card or PLCC partner strategy.
Oh, right, reaching like 12.67 million members.
Yeah, and now they're rolling out their Universe 2.0 platform. It's this predictive engine that basically automates the whole sales funnel by anticipating purchasing behavior. It sets a capital efficiency benchmark that non-banks just won't match without equivalent proprietary data.
That's incredible. Speaking of evolving models, I wanted to quickly mention that WFR Financial Ecosystem Conference keynote this week.
Oh, the one about the venture capital mindset.
Yeah. A senior policymaker was urging Korea's traditional collateral-based lending framework to evolve into more of a venture capital model.
Which is a huge shift. Applying that mindset to standard lending would completely rewrite Korea's financial stability metrics.
Definitely a provocative thought to leave you all with, just raising the stakes on the sector's overall risk appetite.
For sure.
So, to wrap up our deep dive today, what is the bottom line here?
For you as a regulatory professional, the target-based CIR mandate exposes financial groups to an unpredictable compliance burden that could heavily distort credit allocation decisions. At the same time, the 15.2 trillion won deposit drop is a massive stress signal for mutual finance, meaning we must watch whether upcoming FSS inspections trigger even tighter cooperative liquidity rules. Ultimately, the compliance risk direction points toward aggressive, multi-layered regulatory intervention across both commercial and cooperative sectors.
As today's AI PRISM Finance Daily. This deep dive was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a Won IFRA award-winning series. We'll be back tomorrow.